You wake up one morning, your investments are down by 40%. The news calls it unprecedented. They call it a black swan. Nobody saw this coming. That's a lie they tell every single time, because this isn't the first time. It happened in 1637. It happened in 1929. It happened in 2008. And every single time, right before it happened, people were saying the exact same thing you're saying right now. This time it's different. So stick around, because by the end of this video, you're going to look at your own portfolio differently. And the last chapter, the one about 2027, is going to be the most uncomfortable 5 minutes you watch this week. Chapter 1, 1637. You are a Dutch merchant. Your country just got rich. Trade ships, spices, money flowing in faster than anyone knows what to do with it, and there's a flower everyone wants, a tulip. Not because it feeds you, not because it builds anything, just because it's rare. And rare things make you look rich. You buy one bulb. It costs as much as a house. You don't blink, because last month your neighbor bought one and already doubled his money. You don't even buy the actual flower. You buy a contract, a piece of paper promising tulips next spring at today's price. You've never even seen this tulip bloom. You don't care. Prices climb, then climb again. A single bulb is now worth more than a skilled worker earns in 5 years. Nobody is asking what a tulip is actually worth. They're asking what someone else will pay for it tomorrow. That question, that's the whole bubble. Then one day, at one auction, in one room, nobody raises their hand. The price doesn't slide. It falls off a cliff in a single afternoon. The contract in your hand, the one that cost you a house, is now worth less than the paper it's printed on. You go from rich to ruined before dinner. Chapter 2, 1929. Fast forward almost 300 years. You are an investor in New York. You don't have a lot of cash. You don't need it. Your broker says, put down 10%. I'll lend you the rest. You put in $1,000. He hands you $9,000 more. You now control $10,000 of stock. The market only goes up. That's what everyone believes. Your barber gives stock tips. Your shoe shine boy gives stock tips. Everyone's doing the same trade you are. Borrowed money, chasing a number that's only ever gone up. Nobody is asking what these companies actually earn. Nobody is asking what happens if the price drops instead of climbs. Then, one September, it dips. Just slightly. But you didn't buy with your own money. So your broker calls. He wants his $9,000 back. Right now. You don't have it. You sell what you can. So does everyone else. At the same time, the small dip turns into a stampede. Selling pushes the price down. The falling price triggers more lenders demanding repayment, which forces more selling. It's not a crash. It's a chain reaction with your name attached to it. By the time it stops, a quarter of the country has no job. It takes 8 years just to get back to where it started. Chapter 3, 2008. Skip ahead again. You are a homeowner, or maybe a banker. Doesn't matter which. You're inside the same machine either way. This time it's not a flower, it's not a stock, it's your house. The bank says you qualify for a mortgage. You don't ask too many questions. Why would you? Everyone knows house prices only go up. What you don't see is what happens after you sign. Your mortgage gets bundled with 1,000 others, sold to investors as one safe package. Stamped safe by the people whose entire job was to check that. Because it's labeled safe, more banks want in. So they approve more mortgages to people who can't really afford them. Because now the demand isn't coming from people who want houses. It's coming from investors who want more bundles to buy. The system isn't broken on purpose. It's just rewarding the next risky deal every time because the last one hasn't failed yet. You don't even realize you're a domino until payments start getting missed. Quietly, at first, then everywhere, at once. Banks that lent the money can't get repaid. Banks that bought the bundles open them up and realize what's actually inside. The safe investment was never safe. It just hadn't been tested yet. Houses you thought would only rise, lose 30, 40% overnight. The safest asset in America nearly takes down the entire world economy. Chapter 4, 2027. 3 stories, 3 centuries, same exact shape. Step 1, something new shows up. A flower, a leverage trick, a mortgage product. Step 2, people stop asking what it's actually worth. Step 3, borrowed money pours in to chase it higher. Step 4, the only thing holding the price up is the belief that it keeps going up. Now stop, because this next part isn't history. This is today, right now, in your own portfolio. First, the AI boom. A handful of companies, all tied to artificial intelligence, now make up more than a third of the entire U.S. stock market. That concentration has only been seen one other time in market history, right before a brutal, multi-year crash. These companies are spending hundreds of billions building data centers and chips, betting that AI demand will justify the spending years from now. Nobody knows yet if it will. The market is pricing it in like it's already guaranteed. Second, mega-cap concentration. It's not just that these companies are big, it's that index funds and 401ks automatically pour money into them, every single payday, regardless of price. You don't have to believe the AI story for your money to bet on it. Your retirement account does it for you, automatically, whether you ask it to or not. Third, private credit. Outside the public markets, a massive shadow lending industry has grown, trillions of dollars in loans, made by funds instead of banks, sitting outside the regulations that were built after 2008 specifically to catch this kind of risk. Nobody fully agrees on how much of it is actually risky. That uncertainty, that's exactly what existed with mortgage bundles in 2007, right before anyone realized how bad it was. Fourth, government debt. The U.S. government now spends more on interest payments than on national defense. That interest bill keeps growing, regardless of who's in charge or what policy gets passed. At some point, that bill has to be paid by raising taxes, cutting spending, or printing more money. All 3 options eventually touch your savings, your job, or your purchasing power. Fifth, passive investing. Most people today don't pick stocks. They just buy the market through an index fund, which sounds safer, but it means trillions of dollars now move in the exact same direction, into the exact same companies, with nobody checking the price along the way. In 1929, leverage made the crash faster. In 2027, automation could do the same job, just quietly, in the background, every 2 weeks, on payday. None of this means a crash happens in 2027. Nobody can hand you a date. The merchants in 1637 didn't get a warning. The investors in 1929 didn't get one either. But if history repeats, the ingredients are already on the table. A new financial trend almost nobody fully understands. Check. A belief that prices can't fall. Check. Borrowed and automatic money chasing that belief. Check. A system that keeps saying yes, because saying yes has been profitable so far. Check. Could 2027 be next? Nobody knows. But you now know exactly what to watch for. Ending. The flower wasn't the real problem in 1637. The stock wasn't the real problem in 1929. The house wasn't the real problem in 2008. The asset changes every time. Tulips, stocks, houses, maybe AI next. But the real cause never changes. People stop buying cash flow. They start buying a story that says, this time, the rules don't apply. So here's the only question that actually matters. Look at what you're holding right now. Are you holding it because of what it's actually worth? Or are you holding it because everyone else is, and so far, that's worked? History won't answer that question for you. Only you can.